to this session on the domestic economic outlook in 2024. My name is Andrew Barker. I'm a senior economist for CEDA, and I'm very pleased to be joined here by our panellists, Lucy Ellis, the chief economist at Westpac, Sherelle Murphy, the chief economist for EY Oceania, and also joining us online is Marcus Bruckner, Professor of Economics at ANU. So it's a great panel that we have, and I'd like to see some great questions reflecting that. For those joining us on the live stream, you can ask questions from the link to Pigeonhole on the app, or by going through ceda.pigeonhole.at. For those in the room, the details of Pigeonhole are available on your table, and should also come up on the screen. And you can also raise your hand and we'll have roving mics as well, in which case please introduce yourself by name and organisation. So globally, we've just heard about the global economic outlook, real importance of the outcomes from the US election this year, some concerns about risks of increasing protectionism, some uncertainty around the outlook for China, but still expecting growth there of close to 5%, which, as mentioned, is still pretty strong by developed countries' comparison. Now focusing on Australia, where I think it's fair to say we talked about some of that uncertainty globally, but there's also a bit less uncertainty in the Australian economy than there has been in the last few years. You know, we've got past all the ups and downs from the pandemic and the rebound from that. Growth this year, as Cassandra mentioned earlier, is not expected to be particularly strong, but nor is a recession expected. Less interest rate change that this year is anticipated than the last couple of years, although we can talk a bit more about that during the discussion. And we also heard how unemployment is rising a little bit. We need to not lose sight of the real personal costs associated with that and sort of minimise that increase in unemployment. But on the bright side, inflation is moderating. And, you know, we're a bunch of economists here. It is sometimes referred to as the dismal science, so it's nice if we can focus on some of the positives sometimes. So I'd like to start with a focus on Lucy, your outlook for 2024, but particularly on the inflation outlook this year.
Thanks, Andrew. And maybe before I start, I should point out Saul Eslake, who used to be the chief economist at ANZ, recently pointed out that we're called the dismal science because of our opposition to slavery in the 1800s. So I'm actually not sorry about that title. And perhaps that, you know, focus on individual human behaviour and focus on the freedom of individuals to choose is actually something we should take a bit more pride in. But in terms of the outlook for inflation, yeah, we certainly expect inflation to keep coming down. You know, remind the audience that actually inflation ended 2023 a little bit lower than what the Reserve Bank had expected 3 months previously. Although if you look at the forecasts that were made sort of 12 months ago, both in the private sector and at the RBA, things have turned out pretty much as was expected. There has been slow growth, but not a downturn. Unemployment has started to drift up, but not precipitously. And inflation has come down a lot. And the fundamental analysis is because most of that was a supply shock. It has taken time to unwind, but it is unwinding. And we expect more of that unwind over the course of the year ahead, partly because we're still going to see slow growth, particularly in consumption. The household sector is being squeezed three ways, not only by the rising cost of living, because inflation has been high, but the tax take has been rising with bracket creep, as well as for some, the effect of higher interest rates on their debt payments. And all of those things have been operating at the same time. And in fact, the drag on incomes from the rising tax take has been higher than the drag from interest rates. So all of that has weighed on consumption. That has meant that demand is softening. We are now starting to hear from our customers that although their costs are still rising and they are still contemplating needing to pass some of that on, they're also very conscious that they, in some instances, they have hit the limits of what customers will bear. One of my favourite quotes from one customer recently is people just won't pay more than $12.50 for a schooner. But what are they doing? And they're not just taking that on their margins. It is actually concentrating management minds on productivity. So one of the reasons we are reasonably optimistic that that productivity rebound will happen is because of the nature of it, but also because one of the ways you deal with a higher cost base in a slow demand environment is you start thinking about ways to be more efficient, and that actually drives some of that decision making. So we're expecting inflation to come down over the course of this year. We're expecting the growth outlook to be still very slow in the front half of 2024, but we're expecting, as the year goes on, tax cuts come into play. With the changes to that package, more people will benefit from that. We've already seen that in consumer sentiment measures. And then, of course, towards the end of the year, our expectation is we will start to see at least some limited interest rate relief. And together with that easing pressure from rising prices, we are going to see that triple squeeze on the household sector be starting to ease.
Great, thanks, Lucy. Good to hear some positives in the outlook there. One thing you touched on a couple of times is the implications of fiscal policy, so the drag on consumption from tax, also the tax changes coming in the middle of this year. Marcus, I was hoping you could tell us about your views on the outlook for 2024, but a particular focus on the fiscal side of the outlook. Thanks.
Yeah, okay. So I hope you guys can hear me well. So my view is that the year ahead for Australia, it's a year of modest growth, real GDP growth. My reading of the different forecasts, let's say made by the IMF or by, let's say, central banks, Australia, it's going to come in somewhere around 1 to 2% per annum. That's real GDP growth. So in per capita terms, with due to immigration, probably going to have population growth of something like 1%, something like that. So GDP per capita growth is going to come in at about, something like 0 to 1% per annum for the year ahead. That's my view of what's likely for the year ahead. So it's a year of modest growth. It's unlikely that there'll be a major recession. It's not going to be a major boom year. So I said I'm going to focus on the fiscal side. And I'd like to point out that Australia is in a really good fiscal position. So gross public debt as a percent of GDP is something like 35%. And, given, plans for certain expenditures in the years ahead and, estimates of tax revenues, it's likely going to hover around that 35% mark. That's very, very low in international comparison for advanced economies. And that's a good thing for Australia, because it means that Australia can borrow, the public sector can borrow, and there's not going to be much inflationary pressures coming from the fiscal side with regard to debt sustainability. And that's great, and I would like to point that out. Australia has a AAA rating with regard to its public debt, and that's outstanding. Now, with regard to forecasts, many of these forecasts are based on econometric models, and I just want to point out that one of the key assumptions in those models is that the parameters are stable, right? So one assumes that the dynamics of the past continue into the future one way or another. And so there's always some uncertainty with regard to the forecast that comes out of the model. And of course, shocks can come up, right? So what's a shock? So the shock is something unexpected, right? So unexpected events can always come up, but if things are, as normal, then I think Australia will have economic business will be as usual. That's my main view for the year ahead.
Great, thanks very much, Marcus. That's very helpful. start, and good to have that international context when we've just had the international discussion as well, thinking about our debt compared to a lot of other countries. We also heard in the international discussion a lot of discussion around productivity, the importance of productivity. We've been talking about that a lot recently. It's had a really big focus, which we see as a real positive in terms of the big focus at CEDA, because productivity is very important for long-term incomes and living standards. But it has fallen recently. We heard Australia at the bottom of the pack internationally. Sherelle, can you tell us about how much productivity's fallen, why it's been so weak, and whether we can maybe expect a rebound in 2024, as Lucy alluded to, trying to have some positives again?
Sure. Thank you, Andrew, and good morning, everyone. So, yes, productivity has fallen in the last year, according to national accounts. If you measure, let's talk about labour productivity. So GDP per hour worked fell 2.1% in the year to the September quarter. It's only about a 0.9% fall if you do it on a market-based term. So you take out the non-market part of the economy, which is, pretty bad, obviously. But there's so much of this that's tied up in the pandemic that we have to clearly remember that before we think about that number as too poor. But I'd also say that productivity has clearly been kind of declining, or productivity growth has been declining really since the 1990s. So in some ways it's the kind of tale of an already bad story. But if I can just tackle that perhaps in the two parts. One is, what is it that's tied up with the pandemic? Well, obviously when you look at productivity, GDP per hour worked, if you've got GDP or hours worked changing, then obviously that formula can change. And what we've seen through the pandemic, particularly kind of in the second part, was the big surge, of course, in employment and the big surge in hours worked, but GDP wasn't keeping up with that. So that's one of the simple reasons that we had productivity declining as it has. So that makes us think, well, what happens next? Now, clearly, we've started to now see a decline in hours worked across the economy. Not a bad one, but certainly something more normal, which means that when we get the next productivity number, just by the way that the maths falls out, it does mean that we'll probably see productivity either be less down, but probably up. So that's one thing. And it's maybe one of the reasons also that we do compare poorly internationally, because we are a little bit behind in the cycle in that sense. So in some sense, we're kind of, dragging our feet a little bit here because we went into the pandemic in some ways a little bit later and it was more drawn out. But I think the bigger question here really is, what is it that's caused that declining productivity over a number of years, if not decades, that we've seen, and what happens next there? Well, we know clearly that there are a number of factors that have kind of held up our economy and caused it to not work as well as it might have to get the better productivity numbers, but a lot of it is actually really just quite hard to explain as well. Now, from the government's point of view, there's obviously some things that they can do and are thinking really hard about right now in terms of how they loosen up the economy to make it work more productively. And I think the government's competition review at the moment is probably one of the, a good example of that. But there are a number of things, I guess, we look forward and we look at the literature and, what's worked in other countries that we could be doing better here, a lot better. There's, to take one example, and I'm using the work here of E61, which is a great research institute, and the work of a former colleague of ours, Dan Andrews, who will talk about the fact that you need employees to be able to move around the economy more easily than they do. Now, we're putting in place a number of impediments to that. We have stamp duty, which means it's very hard to physically move locations. We have rules about non-compete clauses in various employment agreements, which means that a lot of workers can't work with a new employer for a period of months after they leave the last one. Now, really, do we need that as broadly as we have those rules? It doesn't just apply to sort of professional services or companies like EY that I work in, but also, hairdressers, gym instructors apparently are subject to these clauses. So I think there's a lot of work to be done there, and I genuinely think the government is thinking a lot about this. But it also has to be quite honest with itself, I think, and say, well, yes, we're working on a lot of things here, but what are we ignoring? Are some of the changes in the labour force actually impeding our productivity agenda? So it's a multifaceted question and answer.
Can I just follow up from that? So I agree that the dynamism of our labour market is really important, and that was something CEDA focused on in our submissions to the employment white paper process. But something else that came up earlier that Paul was mentioning was about our business investment has been pretty weak, and we're talking about labour productivity, so capital deepening really matters. There's sort of reasons why we might expect a boom in business investment. We've got these new technologies, we've got labour shortages, but on the other hand, we're not really seeing it in the RBA's measures of business investment intentions. I guess, is there upside there? Do you see business investment coming back? I'll start with you, Sherelle, but others can jump in.
Yes, certainly. When you think about why would a business invest, well, it needs to kind of believe that there's a growth story ahead. And I think, particularly in that pre-pandemic period, we were in this kind of not very fast economic growth period. It was sort of running maybe 2-3%, nothing special. A lot of companies, I think, had kind of thought, well, we could invest into this economy. We have to believe that there's something to invest in. So I think one of the things that was interesting about the pandemic is when we did start to see the consumer, pick up again, and all the fiscal stimulus that was in the economy, it did actually give a little bit more energy, I guess, to the business investment story. I think the concern, though, is that going to last? We have so many reasons that the business environment may remain weak because, clearly there's a lot of risks out there. We've just been talking about in the last session, what might happen geopolitically, what will happen with the US. Do we want to be taking big punts into this kind of an environment? So, I think there's definitely reasons why the business sector may remain cautious in that kind of environment. On the other hand, I'd say that one of the things that's kind of been driving some of the business investment that we have seen is actually government policy itself. So think about the amount of money that's going into defence right now. There's a lot going on in that sector, and the trickle-down effects of that are quite extensive. All the infrastructure that we've seen, particularly in Sydney and Melbourne. Again, a lot of kind of flow down into the business sector from those particular large road, rail, airport projects, which is, doing great things for the economy around Parramatta, for example. So, again, not a simple story. It probably depends a lot in the sector, and I guess how forward-looking a lot of these companies are.
Yeah.
I mean, I would completely agree with Sherelle that government decisions about what to spend where in infrastructure does absolutely have ripple effects on business decisioning. But I think where I would like to go with this question is actually to roll back up to a cross-country perspective. You're absolutely right that there are things like non-compete clauses are absolutely damaging to the level of productivity. But non-compete clauses are even more pervasive in the US. Bad infrastructure, weird regulation. All of these things are much more pervasive in the US, and yet they route around it. And I think that's a really important perspective. Again, looking at the countries, Paul mentioned that Australia was at the bottom of the heap in terms of where measured productivity had gone. The only other country that's as bad is Canada. What do we have in common? A really big population surge after our borders reopened. And that wasn't just about our own borders reopening, it was about China's borders reopening, and therefore all the students arrived at once. We have a pig in the python population problem. That's way too many peas. I shouldn't have tried that when I was mic'd up. But we have this surge population that will not be repeated in 2024. And so, Sherelle's absolutely right. Hours worked has surged in Australia. Part of that is because participation, the real strength of the Australian economy is not only because of flexibility, but we've been able to produce more participation and more hours worked. We use the hours margin really extensively. In November, the participation rate in Australia hit an 114-year high. We've been able to produce labour supply, partly because of the cost of living pressures. People are offering more hours. But the cost of that is just, even non-subdued investment growth would not have been able to keep up. And so what we're seeing is just, in some ways a ripple effect from the pandemic. The borders reopened. We had a surge in in population. Mechanically, that's caused a decline in productivity. As population growth slows, the capital labor ratio will catch up mechanically. And I think there's room to be cautiously optimistic, even regardless of whether business decision makers doing things differently. And I think another really important aspect I'd focus on, culturally in Australia, our policy-oriented communities just sort of automatically start thinking about productivity. That's a government problem. We have a productivity commission. It must be government policy. Well, productivity isn't something the government does to us. It's something that is decided by the way we organise ourselves, by the way we adopt our technology, by the way we arrange our business. And I think, Marcus, I completely endorse your point about the limitations of the kind of models we all learned in grad school. I think one of the really big omitted variables is that management bandwidth in an organisation is a finite resource. We spent the COVID years, everyone just surviving COVID. We spent 2022 and 2023 just trying to find enough labour because of that effect of border closures and the opening up. It's only really now that businesses, that our customers are starting to think about, well, expansion, productivity, investment into reducing their cost base, investment into enhancing their productivity because they had limited bandwidth. So I guess one thing that government can do is actually not be the source of monopolising management bandwidth and allow our customers and allow businesses to focus on actually changing, reaping the benefits of AI, reaping the benefits of investment, making those investment decisions instead of spending their whole life saying, how are we going to get the workers, how are we going to make hybrid work, how are we going to meet this government mandate, that government mandate.
Can I just add another point to that? Another level, I guess, of thinking about productivity is even at the sort of societal, cultural level. So I'll give you an example. So we, as a kind of an economy, have clearly had much more even workforce participation between men and women over the last sort of 30, 40 years. It's, not even, but it's much more even than it was. But what we haven't had in that period of time is occupational kind of levelling up. So in other words, women tend to still be nurses and men still tend to be mechanics. A lot of that, I think, is quite cultural. And if we shifted it so that men could more easily become nurses and women could more easily become mechanics, we actually might find that people find the job that's better for them. And if people are in the job that's better for them, they're more productive. They enjoy it more. They have a better time. They're more enthusiastic about going to work. So, it's such a kind of a multi-layered issue. It's very interesting to see all the different things that might actually affect it.
It's a fantastic idea, Sherelle, and one of the things I've been mindful of, and we put out a client note about this just last week, and for those of you who don't know, all of our research is freely available to everyone on Westpac IQ. But the real issue that we have is it's not so much mechanics, it's the construction industry. We were talking earlier about, the bid from state and federal governments on infrastructure. Well, we need that infrastructure to be built if we have strongly growing population. But what we're really seeing, and we're seeing this particularly in the home building sector, is Australia's doing actively badly on, even relative to Canada, on the cost base for home building and other construction. So maybe your idea, which I think is a fantastic one, we just seem to have an incredible limitation in our capacity to just build. Our construction industry is actively constrained. There is a huge backlog of partly built homes that were originally initiated with the home builder program. It's got nothing to do with zoning. Those homes are already approved. It's just the construction industry hasn't been able to build them quickly enough. And ChatGPT cannot build lay bricks. ChatGPT cannot build homes. So I love your idea. We've got to find a way to expand supply capacity in construction.
And equally in the health and social services sector too, right? A sector that's clearly been growing very quickly and will continue to grow. And I think about my own cousin who was kind of always told that, here's the set of jobs that you will go into as a boy, and the set of jobs that I would go into as a girl. I didn't really kind of follow that path, but nevertheless, I sort of look at him and think, gosh, he would have been a great primary school teacher, or a great childcare worker, but he was never kind of given that option. I just think that's kind of up to all of us, right?
No, I think there's a big cultural shift there, and we've also been doing research on occupational gender segregation, and so I'm really glad you brought that up. I want to get back to some of the questions, though, and bring Marcus in. Our most popular question is about Taylor Swift, believe it or not.
I was wondering if that would come up.
You've mentioned cost of living pressures, and it does raise this point about we have another question too about the sort of distributional effects of the cost of living pressures, about people who are facing those cost of living pressures more than others, and the Taylor Swift question is pointing out that there's no sign of the cost of living pressures in terms of demand for Taylor Swift tickets and merchandise. So, Marcus, we don't need a detail on Taylor Swift's concerts, but just some comments on the distributional consequences of the cost of living crunch that Australians are feeling.
Right. So, yeah, it's often said that the poor suffer, the relatively poor, right? And I think Australia, people aren't really that poor, but the ones that are relatively not so well off, they typically, suffer most from unexpected inflation. Now, that being said, on the tax side, right, we've seen significant changes in taxation that have benefited the relatively not so well off, and it's also the case that inflation has come down. So, yeah, I think that the relatively poor, let me just use that term in Australia, the not so well off, that they've suffered disproportionately from the surge in inflation that Australia and many countries in the world, by the way, experienced in the past two years or so. But at the same time, it's important to point out that the labor market was really tight, in the sense that there were many vacancies relative to those who were searching for jobs. So, I think by and large in Australia, there are very, very few people who are really, really in trouble, right? They may not be super rich, right? But they'll always have something to eat. Right. In some countries in the world, that's not guaranteed. So I just want to point out that even though, yes, there are distributional issues associated with unexpected inflation, and inflation is coming down. I share that view with many people probably in the room. I think it's not so bad.
Yeah, and thanks.
With regard to inequality, even though inequality is there, in absolute term, poverty rates in Australia are very, very low.
And the point you raise about the unemployment rate and the benefits for people from being in employment is a really.
If they want to have a job, they will. It's not so hard to find a job.
Yeah, and
and my view is that will remain true in the year ahead. Unemployment rate ain't going to go up by much. Maybe 4%, 4% something, but employment prospects are pretty good.
Yeah, and that has real benefits across our population. The question about distribution of household consumption also touched on differences across age cohorts or across housing types. Did you want to comment on that at all, Lucy?
Sure. I think this has been the cycle where the distributional effects of policy have come to the fore the most. But we do have to keep it in perspective that macro policy, and I'm referring both to the tax and transfer system as well as monetary policy, have always had distributional effects. And that's true on the downside as well as the upside. When interest rates are low, my former colleagues would get unhappy letters from retired people who are living on their savings. And when interest rates are rising, they get unhappy letters from people who are in debt, and in particular people who own investment properties. So it's a nuanced picture by income cohort. I think it is true that there's a much clearer age picture, and there has been, some work. We've seen it in our own data. Some of our counterparts in the other commercial banks have seen this in their data as well. That older households who have a significant buffer of savings are actually doing and don't have a lot of debt, are not doing too badly, particularly if they're in the older cohorts that aren't paying a lot of tax because of the way the tax system works here. So the households that are really getting caned are the ones who are either renting or have a lot of debt, so their housing costs are rising quickly. We've got to remember the squeeze on rents that we've seen right around the world, including Australia, because of the population and pandemic-related responses. So that their housing costs are being squeezed. A lot of sort of basic things are the things that are rising in cost, like electricity. You've got to remember that Russia invaded Ukraine in late February of 2022, and the first time Australians saw that in their electricity bills was July last year. It's been very drawn out, and people are still hurting from that. Whereas in the US or in particularly in Europe, headline inflation rates at least are being flattered by the unwind of energy costs from their peaks in 2022. So younger households, particularly in the middle income, they haven't necessarily been able to expand their hours the way lower income workers have been able to. They haven't had the income benefit of going from being unemployed to employed. So you've got this squeeze in the middle relative to a less of a squeeze at both ends. But we do have to keep this in perspective, that there are always distributional effects of these various policies. And I think the fact that we do have automatic CPI indexation of the welfare system, the fact that we that tend to then translate into the minimum wage in the decision-making process of the Fair Work Commission, does have an important cushioning effect for the lowest income groups, and it's sort of the people a bit further above that who've pulled back. And I think what we're seeing is there has been a lot of reshuffling of spending expenditures. I hear from my colleagues, people will cut back on a lot of things. They might, save up to go to, the one-off Taylor Swift concert, but in general, they're pulling back on on the holidays. They're pulling back on whether they buy a new car or something for their house. They're not pulling back on stuff for the kids. The kids' activities are one of the last things to go, but a lot of discretionary expenditure, discretionary services for the adults in the household is really the first thing to go, and you're definitely seeing that amongst certain cohorts, and we see that in our data.
We've got a good question here on tax reform. Obviously, as economists, we see a lot of opportunities to improve our tax system, but politically it can be very difficult. So the question is, what event or circumstance is required to trigger structural tax reform in Australia? Do you want to start, Cheryl?
4-year election terms would be a good start, I think, because, it's so difficult to take the first major step, because it's going to hurt in the beginning. It's going to be very difficult to convince the voter base to kind of go along with the kind of policies that we probably need. And, there's so many examples of this. Obviously, our carbon tax, the New South Wales attempt to sort of replace stamp duties with broader land taxes. These are really politically difficult. So if we've got longer terms of Parliament, I think we stand a better chance of getting these harder policies through, because the government has a chance to show that they actually start to work within one term, and for them obviously hopefully two. I think that's actually the answer to a lot of policy problems too, by the way. I think from here, we're, as the Prime Minister said yesterday, we're kind of effectively in an election cycle. We're somewhere around about 12 months before an election, roughly. It'd be really nice to see the government start to lay out the plans or try and build the case for tax reform going forward in its next term of government. This is when it should be starting. I think the government has to be brave. And I think this government's done a lot of good things, but it has to be braver. And it has to get some of the changes in place that we need. So many of them. I think, interestingly, Danny Wood's speech that she gave just before she left the Grattan Institute was a particularly good example of laying out the problem why it is so difficult to get tax reform done. There are so many interest groups who are very noisy, and it's a difficult and complex case to make, but gosh, we need it.
Right. Anything to add?
Sure. I agree. It's hard under the current structures to get brave, politically difficult tax reform, and I guess that's why in my proposal last year, I focused on what I thought was actually a bit more politically achievable, precisely because it doesn't, hit so many of those hot buttons. I mean, recently we've sort of seen debate in the media again about, well, let's get rid of negative gearing, let's do something. Well, that's in isolation not the issue, and the number of submissions about housing affordability that my former employers had put in that I was directly involved in. It's not negative gearing in isolation. It's the interaction with capital gains. So that's why I've proposed, firstly, reducing this issue about tax drag and bracket creep by indexing tax brackets at 2.5%. That way you get the same amount of indexation on average as CPI indexation, which is what you have in the US and Canada, but you retain the automatic stabiliser of a higher tax take when inflation is high and a lower tax take when inflation is low. So I think that has really good macro stabilisation properties and reduces the burden on monetary policy and the distributional impact that has. But you can also do the same thing with capital gains tax. So if you went back to not exactly the pre-1999 capital gains regime, instead of CPI indexing it, you index it at 2.5%. Well, that's just much easier to implement, but you lose this incentive to pursue capital gains at the expense of rental income. You lose the incentive to gear up in the same way. I think moving where the top marginal tax bracket is makes a lot of sense, but having a number of tax brackets retains that automatic stabiliser. So, I think there are swings and roundabouts to flattening out the tax system. I think retaining the automatic stabilisers in the system are important. And that's why I proposed it. I think that's politically doable. I think it doesn't hit a lot of the tripwires in politics. And it means that you're thinking holistically and systematically about monetary and fiscal policy as automatic stabilisers and as macro stabilisation in a joined up way. And I just think, yes, it's politically difficult to do all these other things that economists think are really pure. So let's focus on what might be doable.
Work with what we have, yeah. And if I can just add a point to that, when you do this indexation of the tax brackets, it also takes discretion away from the government, because instead of being left with an excess pool of revenue at the end of a period of time, which they have to decide what to do with, and therefore become subject to lobby groups and their various kind of political masters or push and pull, it's not an issue because it's already been given back. And that problem just disappears.
Yep, and some of that automatic increasing the burden in terms of income tax, which has generational distributional consequences, is reduced.
Well.
Marcus, did you have anything on tax reform?
Yeah. Well, one thought I'd like to add is that regardless of the type of tax reform that may be implemented, whether rates at the top go up or down, or I think one point that's been not emphasized enough is the importance of time-consistent tax policy. What do I mean by that? Well, that if you announce a certain tax plan, and that in the future, say, taxes will go up for some or down for some, it's very, very important to stick to that. Otherwise, the private sector, well, what reason do they have to believe in announcements with regard to future policy, right? In other words, if government suddenly changes its plan, that's an example of time inconsistent policy. And in my view, and there's lots of empirical evidence, that's the worst kind of policy to have. So regardless of the type of policy implemented, because it adds a lot of uncertainty. And so that's one thought I would like to bring in. Of course, there are interest groups there, and I would agree with many of the things that have been said. And some interest groups are very, very powerful, and they can lobby. And what to do about it, whether longer terms for politicians is that a way out of it? I'm not sure, because there's always this counterexample of longer terms. Well, once in power, right, they may use office for private gains. So I really don't know on the political economy side what's to be done there. But what I'm fairly certain of is that what you don't want is tight and consistent policy. It doesn't matter if it's fiscal policy or monetary policy, macroprudential policy. That's one point I want to throw in.
Thanks, yeah, and that certainty point brings us back to business investment, which we were talking about before, which of course is very important for productivity. And I want to come back to productivity a bit. We've got some good questions that are productivity related, and one of them is about the importance of cities. So there was a lot of talk about agglomeration benefits and the dominance of cities before the pandemic, but during the pandemic, many had predicted this would lead to a demise in the importance of cities. Do you think that's happened, and what's the future role of cities in Australia?
You're looking at me, Lizzie.
If you want to start, I'm happy to.
Okay, so I think this is interesting because we clearly know that high density living is more efficient living, in the sense that we're sharing resources, we're sharing infrastructure. The medical facilities, that sort of thing, are all really important. And we know from international evidence that, this does, certainly, there are definitely productivity enhancing elements to this. We in Australia have got a kind of a strange setup in the sense that we are so city dense. We've got our kind of, big 5 major cities around the country, and we don't spread out very far. And I think it's you that did some work in the Central Reserve Bank, Lizzie. Yeah.
Yes, it was.
I'll let you talk about that. But, that has serious implications also for housing and house prices in particular, and how house prices have risen faster than in many other countries. But I'm going to hand over to the expert on this one.
Well, it's over 20 years since Dan Andrews and I wrote that paper. So one of the things we observed is, firstly, Australia has very low density cities relative to most peer economies. That has changed a little bit with the apartment building boom of the mid-2010s, but not a whole lot. But we also, because of our federal structure, have, in the urban economics literature, a sequence of central places rather than the normal city structure. So in most countries, there's a reasonable approximation of a power law, which comes out of the fact that people move. There are agglomeration benefits to living in urban areas. There are also disamenities in terms of congestion and high housing prices relative to incomes. Your incomes tend to be higher when you're in a large productive city, but your housing costs are even higher. And so those are the cost benefits that people are trading off, and people make those decisions of where to locate, subject to social networks and so forth. But there is a decision around where to locate, and you end up with a power law of city sizes in many countries. And Australia was a bit different because we had state capitals and then not a whole lot after that. More recently, actually, I gave a speech in Geelong in 2019 when I was in my old job. And of course, there has been a huge amount of development between Melbourne and Geelong with the introduction of faster, more frequent trains, and it becoming possible to access different labour markets in that sort of region between Melbourne and Geelong. So, go long Geelong, it is possible to create more well-located land with better transport links, and thinking about getting around a city, getting from one area to another. I think we have to be realistic. Sydney is completely constrained by geography. There's ocean, mountains and national parks. It doesn't have a lot of places to grow. I think Western Victoria, so starting Melbourne, Geelong, we could build a city of 500,000 around Warrnambool, Portland. I think that would be, it's got a great port there. There are opportunities, but we need to think about it as, well, how do we have high paying jobs? How do we get businesses starting there their headquarters outside of those major cities? How do we have universities in those cities that attract more people? You know, Adelaide's kind of doing that now in many respects, both with the defence industry, as you mentioned, but also leveraging into the university sector, and you get holistic benefits from that. Coming to the pandemic effect, it's absolutely true that the cost of living further from your employment declines when you can work at least some of the time from home, and so a long commute 2 days a week is less unpleasant than a not quite as long commute 5 days a week. And so we are seeing that benefit of remote working. That works for some people and not others. You have seen, I mean, you know, during that period, you did see a rebalancing of the house price, particularly apartment price gradient, that the benefit of being close in was smaller. Part of that's also a desire for more space. So while we are a low density city, you've also had a decline in average household size particularly in the large urban areas. And part of that was probably people looking around at their 5 flatmates and saying, I don't want to be locked down with you again. But part of it is probably that you need more space if you're working from home than you had before. And so I think there's a whole range of, you know, complex ripple effects from the pandemic and from the changes in our labour force structure that will have effects on the urban landscape. But again, we can't actually respond to that if our construction industry is absolutely constrained in its ability to design and build a variety of appropriate homes for Australians.
Can I pick up on that point, because you mentioned the importance of infrastructure? We've also got a very good question here about, you know, inflation is steadying, but infrastructure and construction costs are still really high, particularly here in Victoria. That constrains our ability to deliver the infrastructure you need. Shirley, you've already made the really good point about more inclusive labour markets, diversifying the skills we can draw from, but what else can we do? Have you got any comments on either of those points, Marcus?
Well, before that, I wanted to throw in one thought about the role of cities. That's specific to Australia, right? So one of the risks in Australia are bushfires, right? So from that perspective, I mean, among others, right? But it's clear that the per capita costs, you know, of fending off a fire, you know, are clearly much lower if the population is concentrated in a particular region, right? So, you know, from that perspective, I think very much that cities and climate change in general, right? Because it's going to get hotter in the decades ahead. That cities are the future with regard to that. That it's much easier, much cheaper on a per capita basis to deal with the consequences of climate change when the population is concentrated in a specific region than if it's spread out. So that's one thought with regard to the role of cities, the future of cities. And that's something I think clearly where government needs to step in because that's something that will affect many people. Now, can you just repeat the previous question? I think I missed it.
I wanted to give you a chance to have a go at that question too, so that's good. Thanks for mentioning the disaster mitigation.
Yep. Okay.
I do want to get on to the final question, but either of you have any comments on how we reduce the increase in construction costs?
It's a bit of a catch-22, this one, isn't it? Because you need to build infrastructure to build supply capacity to be able to, you know, meet your, or to bring down inflationary pressures, but in doing so, you can often be pushing up the inflationary pressures in the short term. I mean, one thing I've been thinking about a lot over the last few years is the fact that we've had, particularly the New South Wales and Victorian governments, build a lot all at the same time, and at a time when clearly we already had supply side constraints. So you've kind of got demand and supply working in the wrong direction for a good inflation outcome. And the federal government, you know, has some input into this, obviously, through grants and sort of adding incentives in there as well. So to me, it didn't feel like all governments were working together on this, and they certainly weren't thinking about the Reserve Bank. So it sort of feels to me that if we had almost like a kind of a subcommittee to think about some of these issues across governments, which may sound impossible in this country and possibly is, but you might get better outcomes, because if you've got better coordination across the states and the federal government on what's getting built when and where, what are the priorities, then you actually might get outcomes which are better from a macroeconomic point of view. So, it's not an easy task, I understand, but it's one thing that I think could help.
Thanks, that's a really good call out for better coordination. We've got 2 minutes left, and I don't want to hold people for a morning tea, so we're going to finish with it's a question here for the three most impactful productivity reforms. We probably don't have time for that, but I'd like to finish with a focus on productivity, given we've got Danielle Wood speaking this afternoon. So what's the one policy reform that you'd most like to see to boost productivity in Australia from 2024? I'll start with you first, Marcus.
Yeah, so I believe that productivity is the result of, well, two things. One is innovation. The other is how business is done. In other words, how people get along with each other, broadly also related to institutions. Now, on the institutional side, both formal and informal, I think things are looking more or less all right for Australia. On the part of innovation, so technological advances, I believe that the way for innovation to happen is reduce regulation, is that government just steps back, because innovation is always done in the private sector. And it doesn't matter if one includes in the private sector the universities or companies. So, in order to get innovation going, have any kind of government involvement there.
Yep,
that's what I would like to see.
Enable the innovation sector to function. Thank you, Marcus. Cheryl?
I honestly don't think there is one good big policy that fixes this, and I think it's a collection of policies across all the things we've been talking about: regulation, innovation, skills migration, workforce practices at the state, at the Commonwealth level. It's across the board. But if I had to pick one thing that I think would enable all of those policies to come together, I'm going to go back to the idea of extending the federal government's parliamentary term, because I think if it's got more sort of, not so much freedom, but if it's certainly got the space to do the harder policies, I think it starts to enable some of those other things to fall into place. First, change the narrative. We've got to stop thinking that productivity is a government responsibility and recognise that it is indeed a private sector, mostly the private sector's doing. Second, we can reform and enhance the TAFE sector. We talked about issues in skills around construction. We need to make non-university education, further education, more viable. Again, it has been seriously degraded in the past decade. And three, I think we can talk about it as whether it's regulation or other reforms, but if government just simply had a lens of whatever we're doing, whatever new initiative we're announcing, what is it doing to business management mind share? Are we taxing the mind share of businesses and getting in the way of that management bandwidth to actually enhance their own businesses, to reform their own work practices? Are we getting in the way of that? And whether it's IR, whether it's reporting requirements, whether it's various other initiatives that government have that all seem like a good idea in their own right, but each of them is a tax on management bandwidth. And if we could do those three things, I think it would really shift the dial.
Thanks, and that ties in really well with our research on dynamic management capabilities, and having that bandwidth is critical, so thanks for that call out. Thanks also for the pig in a python population problem, which is a bit of a tongue twister, but hopefully now we start to see the benefits from to extend the metaphor, the benefits from that pig in terms of the skills of the migrants that we've got here now. So hopefully that's a positive going forward as well. We'll have morning tea now back at 10:35 for an independent view on the policy outlook with Melinda Salento in conversation with Zoe Daniel, Dr. Monique Ryan and Allegra Spender. But in the meantime, I'd like you to join me in thanking the panellists for the session this morning.
Thank you.